A couple weeks ago, I saw this tweet. I haven't been this excited about a stock in a long time. Nbius is the most undervalued AI infrastructure company in the entire market, and I believe it will soon be recognized. Even Nvidia invested in this company. Almost 10x annual revenue growth, more than $2 billion of cash in the bank with no debt, projected to generate between $500 million to $1 billion of annual revenues by the end of 2025, projected to become EBITDA profitable for the full year 2025, and the market cap is only about $5 billion. In this video, you will learn why Nebius Group is such an exciting stock and whether this excitement is justified or just a hype. My name is Mariusz Konieczny, and I've been investing in the stock market full-time for 16 years. I'm also the author of 11 books on investing and founder of microcapexplosions.com. When I look at stocks, I always try to understand what type of problem that is being solved for the clients. Nebius solves a computer access problem for independent AI companies. We all know that tech companies, startups, and others are developing all sorts of AI applications, and they need access to massive computing power. Consequently, the big players, which are called hyperscalers, such as Microsoft, Amazon, Alphabet, are plowing billions of dollars into buying Nvidia's GPUs to build their own data centers. What about the independent players? What about the startups? They don't have the money to build their own data centers. And even if they had money, they don't have the expertise to build their own data centers. They don't even have access to the best GPUs because they are not on Nvidia's preferred customer list. And the hyperscalers are definitely not going to let them use their data centers because they themselves are scrambling to have enough computing power for themselves. This is where Nebius comes in. Nebius is building data centers filled with Nvidia GPUs to rent out to independent AI companies in need of computing power.
Our ambition is to build data centers with hundreds of megawatts providing AI compute infrastructure and value-added services to the global AI industry.
The company already has several data centers across Europe and is increasing capacity there and entering the United States. In 2024, Nebius generated $117 million of revenues, and of course, the company was not profitable during that year yet. However, the idea is to spend the $2 billion of cash to buy Nvidia's GPUs and build data centers around the world.
We plan to direct most of our capex to purchase Nvidia Blackwell GPUs.
Demand for Nebius services is exploding, as evidenced by the growth in annual run rate revenue, which is up 9x in less than 2 years. The beautiful thing about the AI infrastructure business is that no matter which direction the AI industry goes, the thing that stays constant is the need for data centers and computing power.
Wherever AI goes, it will always need infrastructure.
This GPU as a service industry is expected to grow at 35% per year and reach $260 billion by 2030. Right now, Nebius is trying to grow as fast as humanly possible to get as much market share as possible because
the companies that will be able to provide large-scale, efficient, and reliable compute will be the best positioned to capture a major share of this market. We aim to be one of those key players.
Their 2025 outlook is to reach an annual revenue run rate of between $500 million and $1 billion by spending between $600 million and $1.5 billion on Nvidia's GPUs. Because the company has more than $2 billion of cash in the bank, this goal should be achieved without further dilution. Eventually, the company is planning to grow beyond the $1 billion of revenue run rate with 60,000 GPUs, but this, of course, will require additional dilution. As you can see, in the medium term, Nebius is planning to quadruple its GPU capacity to 240,000 of GPUs. This would mean $4 billion of annual revenue run rate. Considering that today's market cap is approximately $5 billion, the valuation seems attractive in comparison to other AI stocks out there like Nvidia, Nvidia, which is trading for 23 times revenues, or CoreWeave, an AI infrastructure stock, at 10 times revenues. The exciting things about Nebius do not end here, because the company is not just a renter of GPUs. Nebius has serious advantages over its competitors. They are specialists in building data centers.
Our experience is proven. We have expertise in running data centers with hundreds of megawatts power loads and building world-class clouds and services. Let me be perfectly clear. We've done this before and we will do it again.
Nebius doesn't just buy Nvidia's GPUs. They design their own GPU servers and their own data centers. This allows for optimized cooling and heat recovery to improve cost effectiveness. As a result, their servers consume 20% less energy than other GPU servers.
And as you can see here, Nebius server consumes an average 20% less energy than other GPU servers. And when you multiply these results over the full fleet and in data center, you can imagine how much electricity we can save.
Consequently, Nebius can have higher margins than its competitors. Also, the energy cost savings can be shared with the clients in the form of lower prices. So these are the reasons why many investors are excited about Nebius. Some consider it the fastest growing AI company. They believe that once the market discovers Nebius, the stock price will go up. If you like this video so far, I urge you to subscribe to this channel, click on the notification button, and like the video. This helps out the channel a lot. Is the hype justified? Well, Nebius definitely solves a big problem. They will have more clients than they can handle. Revenues are going to continue growing. Clients will continue signing up for long-term contracts. But here's the problem. Solving the AI infrastructure problem is not really beneficial for shareholders. Let's break down this business to the bare basics. Nebius is buying GPUs from Nvidia and renting them out for a fee. The payback period for a GPU is 2.5 to 3 years. That's fantastic, but the problem is that the lifespan of a GPU is only 3 to 5 years. So you tell me, is this a good idea for Nebius to spend $2 billion on GPUs that will be obsolete in 3 to 5 years?
No, hate it. Stupid.
Yes, the company will be able to show revenue growth and profitability, but shareholders will not really benefit much from those profits because the company will constantly have to keep plowing those profits back into CapEx to keep buying newer and newer GPUs. And Nvidia will be laughing all the way to the bank. As you know, CapEx is not part of the income statement. CapEx is found on the cash flow statement. If you don't know what I just said, I suggest you read my book, The Basics of Understanding Financial Statements. Even the CEO of Nvidia said this. Hopper GPUs didn't even last 3 years, and they are already obsolete after the newest Nvidia's GPUs were released.
In a reasoning model, Blackwell is 40 times the performance of Hopper. That when Blackwell starts shipping in volume, you couldn't give Hoppers away. If you're still looking to buy a Hopper, don't be afraid. It's okay. But I'm the chief revenue destroyer. My sales guys are going, oh no, don't say that. There are circumstances where Hopper is fine. Not many. When the technology is moving this fast, and because the workload is so intense and you're building these things, they're factories, we really like you to invest in the right versions.
Nebius reminds me of another company called Rent the Runway that I previously made a video about. Rent the Runway, instead of renting out GPUs, is renting out clothes, which, like GPUs, are depreciating assets that constantly have to be replaced. In 2021, Rent the Runway IPO'd at a valuation of $1.7 billion. Today, the stock is down 99% and the company's market cap is less than $20 million. The bottom line is this: Nebius is spending more than $2 billion to buy GPUs, which are nothing but quickly depreciating assets. So today, you are paying $5 billion in market cap for a company with $2 billion worth of cash that is about to be used to buy a bunch of depreciating assets. Do you think this is a good deal? Let me know in the comments below. If you want to learn about the stocks that I personally own, zone, I suggest you watch the following playlist. If you enjoyed this video, please subscribe to this YouTube channel, click on the notification button, like the video, and thank you for watching.